the beginning of a financial giant. Before Lehman Brothers became a symbol of financial collapse, it was one of the oldest and most respected investment banks in America. The story began in the 19th century when three brothers, Henry, Emmanuel, and Meyer Lehman, built a business that started far away from Wall Street. At first, they were not financial kings. They were merchants. They traded goods, especially cotton, during a time when cotton was one of the most important commodities in the American economy. But the Lehman family understood something powerful. Real money is often made not only by selling products, but by financing the systems behind them. Over time, Lehman Brothers moved from trade into banking, from banking into investment, and from investment into the center of American capitalism. The firm helped companies raise money, supported major industries, and became part of the financial machine that connected businesses, investors, governments, and markets. For decades, Lehman Brothers represented confidence. It survived wars, depressions, recessions, and market crashes. To outsiders, it looked strong, intelligent, and untouchable. But deep inside modern finance, something dangerous was changing. By the early 2000s, Wall Street was no longer just about helping companies grow. It had become a world of leverage, complex products, short-term profits, and hidden risk. And Lehman Brothers was not watching from the side. It was right in the middle of it. The machine behind the 2008 crisis. To understand why Lehman Brothers collapsed, you have to understand the machine that created the 2008 financial crisis. It started with housing. For years, American home prices kept rising. Banks, investors, rating agencies, and politicians began to believe that housing was almost impossible to destroy. The idea was simple. Even if one borrower failed, the housing market as a whole would stay strong. That belief became extremely dangerous. Mortgage lenders started giving loans to people who often could not truly afford them. These were called subprime mortgages. Some borrowers had weak credit, unstable income, or very little ability to handle higher payments later. But the banks did not always care enough, because many of these loans were not kept by the original lender. Instead, they were packaged together and sold to investors as mortgage-backed securities. This changed everything. A risky loan no longer looked like one risky loan. Thousands of mortgages were bundled together, sliced into pieces, rated by agencies, and sold around the world as if they were safe financial products. The system created a dangerous illusion. Lenders made money by creating loans, banks made money by packaging them, rating agencies gave high ratings, investors bought them for higher returns, and firms like Lehman Brothers used massive leverage to increase profits. Leverage means using borrowed money to make bigger bets. When prices rise, leverage makes you look like a genius. But when prices fall, leverage becomes a weapon pointed at your own balance sheet. Why Lehman Brothers fell? Lehman Brothers did not collapse because of one bad day. It collapsed because years of risk were hidden inside a system that depended on confidence. The firm had heavy exposure to real estate, mortgage-backed securities, and risky financial assets connected to the housing boom. As long as housing prices kept rising, the machine worked. But when home prices started falling and borrowers began defaulting, the value of those assets became uncertain. And in finance, uncertainty can be deadly. Banks do not survive only because they own assets. They survive because other people believe those assets are valuable and trust them enough to keep lending money. Lehman Brothers depended heavily on short-term funding. That meant it constantly needed lenders and investors to keep believing in the firm. But as losses grew, trust disappeared. This is the brutal truth of banking. A firm can look alive on paper while confidence is already dying around it. In 2008, Bear Stearns had already collapsed and was rescued. The market was terrified. Investors began asking, who is next? Lehman became the answer. The firm tried to find buyers. Bank of America looked elsewhere. Barclays could not complete a rescue without government support. And the US government decided not to bail Lehman out. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history. But the real shock was not just that Lehman failed. The shock was that the world suddenly understood how connected everything was. One bank's collapse froze credit markets, destroyed trust, and pushed the global economy into panic. Lehman Brothers became the warning sign of a system that had confused rising prices with real safety.